This is powerful. Probably I should have not shared this. Okay, listen, if you spent more than 3 days in a trading space, you probably know the basic theory of how interest rates move currencies. It goes like this. Obviously, central bank A hikes interest rates, central bank B cuts interest rates, then currency A appreciates against currency B. That's like the basics of basics. It's literally the first thing you usually learn. But now, here's what they don't teach you. This divergence doesn't start at the policy level, meaning it doesn't actually start with the interest rates. If you wait for exactly when a central bank starts hiking versus when a central bank starts cutting interest rates, well, you're going to be late to the trade. Here's what I mean. The monetary policy divergence does not start with interest rates. Now, it sounds a little bit confusing, but let me explain. The policy divergence starts with the economic data, the data that forces the central bank's hands to move. I'm going to teach you how to literally read the minds of the central bankers in a minute, so that you can front run the biggest macro trends in the market months before anyone else even notices. But let me give you a real undeniable example so you can actually understand how this plays out. Let's look at the euro against the dollar. So EURUSD, daily chart. It's a classic macro shift in this example. Let's picture this. The US economy is running pretty hot. NFP are printing hot, that's a pretty decent number, well above expectations, also rising from previous, solidly hot. And in the meantime, inflation is actually also rising, okay, well above expectations as well. Now, the macroeconomic data is literally yelling at the Federal Reserve, at least not to cut rates, potentially even hiking interest rates. If everything is hot, inflation is hot, and the labor market is hot, that's the context for the United States. Strong labor market, hot inflation. Meanwhile, across the ocean, in the Eurozone, Germany manufacturing is, let's say, stagnating, to say the least. This is a pretty awful number. Now, admittedly, the Germany manufacturing PMI numbers, it's not really that much of a big context changer for the European Central Bank, but it's important to understand, that Europe is stagnating in growth, okay? It's pretty low in growth. And at the same time, this also matches with what? With inflation, because obviously growth leads to either inflationary if growth is heating up, or deflationary if growth is slowing down. So with weak growth and inflation below target, the European Central Bank targets interest rates at around 2%, so it's dropping from previous, it's dropping essentially below target. As you can see, it's a pretty different picture between the two. The Federal Reserve is nowhere near even probably thinking about cutting rates with this context, while European Central Bank, we could say they could make use of an interest rate cut. Okay, growth is slowing down, inflation is below target, they got what they need to probably cut rates if they need to. Now, we've set the ground for the divergence. And as you can see, we're doing it with very little data. We're not tracking all sorts of data points. We're just watching the labor market and inflation. We're just understanding what matters for the central bank so that we can anticipate what they're likely going to do next, whether they're going to hike interest rates, whether they're going to cut interest rates, whether they keep higher for longer rates, and so on and so forth. With this little piece of information, we understand that two economies are essentially in different shapes. The Fed will not cut interest rates because we understand the Federal Reserve targets the labor market, they want maximum employment, and they want price stability. So they want a strong labor market, and they have it, but they also want what? Price stability. And 3.5% inflation rising well above the target is not exactly the price stability they want. And with a strong labor market, they can afford to actually tighten interest rates in order to bring lower inflation. Now, Europe is in a different context. They have weak growth, which brings inflation down, and they have inflation actually below target. So they need to handle things differently, okay? So they could make use of an interest rate cut, while on the contrary, the United States could make use of an interest rate hike. Now, what happens right here, right now? Because this is the secret. This is the hidden gem that I want you to understand. Does the market wait for the European Central Bank to either cut interest rates or hold with a dovish bias to actually sell the euro? Well, it does not. As you can see, in fact, EURUSD has been trending lower in this context. Now, this is not the context right now, don't get me wrong. This is an example of an historical context. And basically, the market sees the data diverging already. It sees hot US data and it sees cold European data. And so it starts to price things in advance. By the time the European Central Bank officially cuts interest rates, 25 basis point cut, EURUSD has already dropped what? 300 pips, 400 pips? The central bank policies were just a lagging confirmation of what the data already proved. Strong labor market in the US, hot inflation, weak growth, and weak inflation in Europe. See what's going on here? If you miss this particular detail, you miss the whole point in fundamental analysis. I'm not exaggerating, because if you wait for the actual interest rate decision to understand, well, okay, there is a divergence, you're going to be late. So let me make this practical for you. You don't need a degree in economics. You need to watch just two things, two variables: the labor market and inflation. These are the two inputs that go into every central bank decision, pretty much. Because here's what people forget. Central banks do not make policy at random. They don't just decide to hike interest rates or cut interest rates because they want to, because they think so. They react to data. The exact same data that we have, everyone has access to. It's public. So by understanding what the central bank looks at, we understand how they're most likely going to react. So when you see a divergence in the data between two economies, labor market and inflation, you see a divergence in the policy that is about to take place. You expect a certain central bank will hike or cut interest rates versus another central bank will do the opposite. And that's the point, okay? You want to position before it becomes too obvious. In this case, if you want to trade the policy divergence. So let's say economy A, labor market strong, inflation rising, so they're moving in a certain direction macroeconomically. Economy B, they're moving in the opposite direction macroeconomically, with the labor market weakening and inflation falling. So in economy A, the central bank is likely to hike interest rates ahead because they need to bring that price stability back. They have a strong labor market to do so, and so they can afford to tighten interest rates to bring inflation lower. In economy B, the opposite is happening. Inflation is low enough and growth is actually, pretty weakening. So the central bank here is most likely going to stay on hold or even cut interest rates, creating what? A policy divergence. But we find this policy divergence in the data ahead of time, before the actual policy divergence becomes too obvious, with a central bank hiking and a central bank cutting. Understand what I'm doing here? We're reading the data, the same data that the central banks reads to decide what to do with their interest rates and what to communicate about it. And with that, we anticipate what in fact the central bank is most likely going to do next versus what another central bank is most likely going to do. One is going to keep interest rates high, one is going to keep interest rates low. Okay? Now, let me show you another important example to deliver the point better. Let's look at economy A, the United States. In late 2021, if you've been trading for a little bit, CPI inflation started to absolutely rocket higher. It went from 2% to 4% to then 5%, and then eventually even higher. Now, for this example, let's say the CPI that we have right now, so let's say the context right now is core inflation 4.9%, up from 4.6%. So the context is inflation is rising, okay? Inflation is moving fairly above the central bank's, the Federal Reserve target. At the same time, the US labor market is absolutely on fire. NFP doing well, unemployment rate moving to historical lows pretty much. In other words, the Federal Reserve has plenty of reasons to hike interest rates in this context. Why? Because their mandate is being pressured on one particular side, on the inflation side, and not on the employment side. Because employment is doing pretty well, but inflation is going way above target, it's heating up way too much. So this particular context allows for the Federal Reserve to hike interest rates pretty comfortably. Now let's look at the economy B. Japan in this case. Japan's inflation is pretty much non-existent at this point. Wages are negative and their economy is basically stagnant. Bank of Japan in this context has no reasons whatsoever to hike interest rates. They have an inflation target of about 2%, so they want higher inflation and yet they don't have it. So as you can see, we have a massive, important divergence in the data here. The US data is forcing the Federal Reserve hands to hike interest rates, while Japan, not pretty much. So we have a hawkish context in the United States and a dovish context in Japan. hot inflation in the United States, hot labor market, and deflation, disinflation in Japan, and pretty much a stagnant economy in Japan. Okay, this is the divergence in data in this particular context. Now, let me show you where it gets really interesting. Okay, did the Federal Reserve hike interest rates in mid to late 2021 in this particular context with the hot inflation, hot labor market in the United States? Well, I'm going to tell you, they did not hike interest rates. In all this context, they did not even hike interest rates yet, but they started hinting, at upcoming hikes eventually to come ahead. But they didn't hike. And this is the point. See what I'm going here? The trend doesn't start with the interest rate change. It starts in the economic data that forces the central bank to move the interest rates. Now, this is a general rule. It's not always the case because sometimes the central banks can surprise the market and pivot suddenly from cuts to hikes. And that's going to start the change from the interest rate change. Okay, but usually 80% of the time, the central bank is reacting to data that we have access to, that everybody has access to. So we can just look at the data to understand that, hey, sooner or later, the central bank, the Federal Reserve in this case, is going to most likely hike interest rates. The market knows that. The market sees that. The market is smart. And so what it does, it starts to price in an interest rate hike in advance. By the time the Federal Reserve actually hiked in March 2022, USD JPY had already rallied from 105 to 117 before the interest rates hike even took place. Why? Because the data told the market, hinted at the market that, the Federal Reserve hike was about to take place. And it started to price that in advance because the data told it so. After this, policies actually started to kick in. The Federal Reserve started to hike aggressively, and so it went way further in this trend. Now, you get the point here. Hopefully. If you don't, let me know in the comments. I'll try to make it a little simpler. But let me make this even more practical so you can put it into action right away. The point that I want you to understand is you have to track the G10 data. Start looking at inflation and labor market data from the economies that you want to track. Okay? And look, let me go a little bit off script here. You can literally use artificial intelligence for this exact purpose, to do all the heavy lifting for you. Just take this prompt, for instance, act as an institutional macroeconomist, pull the latest core CPI, inflation, and labor market data for the G10 currencies over the past 3 months, summarize which economies are strengthening, meaning inflation up and moving away from the central bank's target, the labor market up also means obviously the economy is strengthening, and which are instead weakening. Create a useful and simple table, and remember, the data is useful in context with what the central bank's targets and projects, so contextualize the numbers. Very important, just hit send. And the artificial intelligence is going to do all the heavy lifting for you. It's going to create a nice table where everything is going to be pretty much well structured so you can see exactly which economies are strengthening, leading to potentially a hawkish central bank versus the opposite. Now, in about 4 minutes and 15 seconds, it comes up with a fantastic table that summarizes everything you need to know to find a potential divergence. Okay, so we got, for instance, in this case right now, in this specific context, it's May 11, and the two particular economies that actually are diverging very importantly, it's Australia, which is in a pretty inflationary context with the labor market doing pretty well, and so the economy is strengthening, and they have a hawkish inflationary context with a hawkish central bank, which it's leading to actually high interest rates. On the contrary, for instance, Switzerland is in a disinflationary context with very low yearly inflation numbers. And this is leading to a Swiss National Bank that is going pretty dovish on everything. In fact, you actually follow us in our public Telegram channel, you know we are actually long the Australian dollar against the Swiss franc. Now, there's plenty more interesting divergences here. There's Norway against Sweden, which is a very regional divergence, which is very interesting. In fact, we're actually long the Norwegian krone against the Sweden krone. And so in this table, with just one single prompt, a very simple short prompt, in 4 minutes, ChatGPT has come up with every single thing you need to know in the economic data, macroeconomically, for every country you want to track. This is powerful. Probably I should have not shared this. So use this table to understand who's weakening in a disinflationary, deflationary context and who is actually strengthening in an inflationary, hawkish, with strong economic context, okay? So the step 2 in this is to find the divergence. Once you have the data, you look at the extremes. You gotta understand you wanna pair strength against weakness. So you wanna find the extreme opposites. If one economy is showing intense strength with combined inflationary pressures and another economy is actually showing weakness with no inflationary pressures, then you got a macro divergence to pay attention to. There's a macro divergence there, so you know what to trade and in which direction. Now, that brings us to step 3, which is to wait for the technical trigger. This is where you make all the difference, okay? Macro divergence tells you direction. I'll just show you that. You can find fantastic trends by understanding the divergence in the data between two countries, anticipating the policy divergence, but you always have to time the entry, okay? You do not blindly market buy just because the data is divergence. You wait for the right technical trigger to jump on the trend. Go on a lower time frame, you go on wherever you want to go, look at the structure breaks, fairly simple, fairly straightforward technical setups, simple corrective structure break that leads to a nice expansion to the upside, or a liquidity sweep, okay? A reversal like this, another structure break. See, the point, you can use whichever technical analysis you like to use, but just use it, okay? Just pair that in the macro direction. If you see a short setup in this, just ignore it. Just look for long setups because you are aligned with the macro direction. That's gonna give you that little extra edge, the actually pretty big extra edge, which is going to make your trades much more accurate, much more smoother, much better in general. So once you have a trigger, enter a trade and then just let the market work for you, okay? This is a macro framework that you can apply immediately. Who is in a position to hike interest rates versus who is in a position to cut interest rates, who is forced to cut interest rates. Don't wait for the actual interest rate change. Start to anticipate it. Start to see that coming ahead of time because you can read the same data that the central bank has access to, so you can start to anticipate the trend, so you can start to anticipate the move that they're going to make, whether they're going to hike or cut. You know that in advance because you look at the same data that they're looking at. That will give you some of the best, cleanest, most aggressive market trends to ride. Now, if this type of content resonates with you, if you're tired of the surface level retail nonsense, and if you actually want to see more of this institutional approach, well, make sure to like the video and subscribe if you haven't yet so you don't miss the next one.